I love looking at certain Fs as I've had great success finding undervalued and other ideas and opportunities within certain Fs. Every single quarter is free to look at. In this video, we're gonna take a look at Michael Burry's recent 13 Fs for Q3 of 2023. It's pretty interesting, but it's one of the hardest to mimic, which is why you should never buy a stock just because Michael Burry bought it. I mean, he's a crazy investor. He rotates a lot. He sold all kind of stocks, 100% of many of them, which is why in this video, I'm gonna take a look at some of the stocks he bought and some of the ones he sold, as I personally own one stock that he sold. I'm gonna tell you which stock I own and just give you my opinion why he sold it in general, or what it could mean for my own investment. So it's going to be pretty interesting. I'm going to try to keep it short and give you a very quick update on a few of those stocks. So I hope you enjoy it. Now, the first stocks that he added to over 23%, it's an interesting one. It's called STLA, which is Stellantis. Most of you maybe are not familiar with Stellantis, but you're familiar with the brands that Stellantis owns, like Chrysler, like something like Fiat, Dodge, Citroen, something like Ram, Alfa Romeo, Jeep, Maserati. Most of you know these brands, but maybe you don't know Stellantis. So it's a pretty interesting company in general. A lot of dividend investors love it. I think it's personally undervalued without the dividend kind of story, but for dividend investors, they love it. This is something I posted on my Twitter, that the yield on STLA is 7.2%, but the free cash flow payout ratio, it's only 35%. This is very, very rare, which is why a lot of dividend investors love it. They don't have much growth, but they have a stable dividend. They return value to shareholders. The balance sheet is not bad at all. I'm planning to do a deeper dive in the future, and I want to keep this video short, but I believe STLA is a very interesting company. It's undervalued. A lot of the car companies and automobile companies, they got beaten down a lot. Now the market is recovering, but a lot of these stocks have not yet recovered, along with the airlines, which are very interesting to me. And this is where I'm personally looking at in my portfolio, and the stocks and industries that have yet to recover with the overall market. Now, a stock that he sold, which is stocks that I actually own, is the GEO Group. He sold 100% of this investment, and it surprised me because normally Michael Burry sells this stock around $8 to $8.50 or $9, and I kind of do the same. I trim a little bit above $8.50, then I buy it again at $7, and now my cost basis is $7.04, something around $7.06, $7.04. But from my cost basis, I'm up around 34%. But Michael Burry sold the whole stock around like $7 or $7.50, which really surprised me, especially what's happening on the border, and they putting a lot of the monitoring devices, electronic monitoring devices. GEO owns 87% of this market. So the company is experiencing some growth in this area. And, in terms of other places, they're experiencing leases and as they're paying down debt, everything is going fine. So I'm not sure why Michael Burry sold it. I'm still holding it personally. I trimmed a little bit, but I still hold it. It's pretty insane. I don't know why he did that, but I mean, he did it. Something like CVS, he sold 100%. I'm not surprised. Maybe he has the same thesis that I have around the management not being too confident with guidance. I did some videos on CVS, so I'm not surprised why he sold CVS, but I'm surprised why he sold GEO. Now, another stock that he bought that's pretty interesting, and I think it's undervalued, is BKNG, which is Bookings Holdings. Most of you are familiar with the website booking.com. Maybe you used it for different kind of things. Now, looking at Bookings Holding and looking at the PE ratio, the PE ratio is now around 18 times. Now, the company used to trade as high as 159 times. That's back in 2020. But in 2021, it traded around 73 times. So it went from 73 times to 18 times for a company that has pretty high margins, good business model, around 25% net income margin, and the EPS has been growing and is still expected to grow around 21% in 2024, 19.5% in 2025, 12 in 2026, and 15 in 2027. So you're buying this company for 18 times earnings with 25% net income margins, growing around 15 to 20%. This is a very quick combination to put in this video. I believe this is extremely undervalued for this company. Of course, we have to do a deeper dive a little bit more in the future. Maybe I'm going to do that, or maybe post some things on Twitter. But just looking at a very quick look with 18 times earnings, what you're getting for 18 times is pretty undervalued. The company has bottomed around 15 times in March 2020, and now sitting at 18 times with enough bad sentiment around the recession and stuff. This is normally the best time to be buying cyclical stocks whenever people are fearful of a recession, and then whenever the recession comes, these stocks recover and people get surprised why these stocks went up. Kind of like what happened with the home builders in 2022, if you remember. Everyone was bearish on real estate. Then you had home builders making new 52-week highs, and people were wondering what's going on. Well, they already priced it in. Everyone was expecting the recession. So this is normally the best time to be buying cyclical, which is why I'm looking into airlines and many different places to try to bet on such scenario. Now, this is a topic that I have avoided for a while, but I'm going to have to talk about it in this video. And it's mainly the Chinese stocks, which is Alibaba and JD. He's bullish on them. Again, he's been in and out of them many, many times. I don't believe Michael Burry is going to hold Alibaba and JD for 20 years, not even 6 months. Maybe next quarter he's out. I mean, this is the kind of guy. He really plays on short-term stuff, on some catalyst kind of change, or maybe some charts on support lines and stop losses and all these kind of things. So Alibaba and JD, I've been trying to avoid this topic, and I'm going to have to talk about it in this video. And Alibaba is cheap. Most of us agree that Baba is cheap, and I used to own the stock. I sold it around the $110, $112. That was like I think in late 2021 or early 2022. But I sold it. Now it's sitting around 9 times earnings. Now the company traded as high as 31 times. So it went from 31 times to 9 times, while the business is still good. It's still succeeding, it's growing, it's gaining market share. Alibaba Cloud is not doing too bad. They are expanding in many different places. In Asia and in China, they're still pretty strong. So the company is doing so well, but the stock keeps going down. And this is the whole thing with Alibaba, with JD and any stock, that most of us are value investors. We tend to look at these companies and see, oh, the stock is cheap, so I want to be a contrarian and buy it. But the problem is that there's nothing that can prevent Alibaba and JD from getting cheaper. Even if the business does so well and does everything you want it, this business and this stock is not controlled by the business, it's controlled by the geopolitical events and how investors feel about something. This is a very good chart of some kind of a survey, and it asks, do you consider China an ally or an enemy of the United States? Now, you could look at this chart, how it started in 2018. 80% consider it an enemy, 8.7% consider it an ally. Now, if you put this chart on something like the Hang Seng and something like QQQ, which is the NASDAQ, and the same thing pretty much in 2019, 2018, they were going up and down together. Since then, the QQQ, which is the NASDAQ, is up 130%, while the Hang Seng is down 33.5%. So something like Alibaba went from 31 times to 9 times. Well, why can it go to 7 times? Why can't it go to 4 times or 5 times? This is how I think about it. Because Alibaba is not, the stock is not controlled by how well Alibaba does, like every single stock. It's controlled by the kind of sentiment and how investors, if they are fearful, if they are greedy, if they are happy with China, they're not happy with the stuff, and the regulations, they keep on increasing between the United States and China, and it's pretty bad. And I personally don't see it getting better. Now, I'm not sure how Alibaba is going to perform, or JD. Maybe they're going to be one of the best performers ever. But if I see more and more regulations on chips sending to China and on investments in China and all these kind of things, it's not getting better. It's getting worse. So I would not be surprised if Alibaba stays the same or goes down a little bit more. But this is the whole thing, that you cannot buy Alibaba just because it's cheap. This is not a regular US stock. You have to buy Alibaba because you think it's cheap, and you have to be somewhat confident that the relationship between the United States and China is going to get better. But the truth is that it's getting worse every single day. And the regulations keep on increasing, and maybe with a new president something would change, but I would doubt that it would change. So this is what you have to look at. It's not just about it being cheap. You have to be confident that the geopolitical event is going to change. And I'm not saying it changing, I'm saying it getting worse. But I believe Michael Burry is owning it for some kind of a short-term trade. He's going to get out maybe in a quarter or two. This is how I look at it. But this was my honest opinion on Michael Burry's portfolio. Some of the stocks, I might do an individual analysis later on these kind of stocks. It's going to be pretty interesting. It was not financial advice. Thank you for watching the video. I hope you enjoyed it. So if you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.